Mark, good morning to you. So thinking about the rates picture and how we go into the non-farm payrolls report today, the rates picture looks pretty steady right now, but the backstory has been that we've been perhaps wrong-footed a little bit by how hawkish we've seen the new chairman of the Fed be over recent couple of weeks. How does that set us up for this payrolls report today?
I think it's a really interesting setup. There's a bit of divide in the market. I've seen some reports out today that this non-farm payroll doesn't really change anything. People have cared less about the jobs market. Revisions are so large. I completely disagree. I think in the short term, this really matters. I admit it's only short term. And the reason I say that is we've got about a 30% probability of a July hike priced in now in US front-end rates markets, about 7 basis points priced in. And I think the NFP today will kind of really decide that, because we're going to want to have clarity whether that number is complete, that chance of rate hike is completely removed on a soft print today, or if we get a very strong print, it becomes a very serious conversation, which they're kind of going to want to get some clarity on before the blackout period. So I think today's non-farm payrolls really matters because we've got a short window of trading afterwards. We then got the long weekend holiday, and I expect we'll see an overreaction. The reason I call it an overreaction, even though I think we've got the importance, is that I think that because of that low liquidity, we can really run with whatever that impulse is if we get a shock out of the print today, that'll run into early next week. And then next week we'll go back to the story, hey, the revisions are massive, they're so volatile, we shouldn't read so much into one print, and we might unwind some of that move. So I am expecting NFP to really matter in the short term today.
Mark, if we do get a strong print and then the bets increase on a July hike, how much of a risk is that to the US stock story?
I think it's short term quite problematic because ultimately it hits the high duration stocks, and that's the AI tech stocks, and they're the ones that completely dominate the direction of the market. So it'll be quite painful at first. But I think ultimately we're going to see higher yields because of a strong, resilient economy. That's a positive reason for higher yields. And that's going to be good for a lot of the value names out there, a lot of small caps, the ones that are more exposed to the economy. So what it'll do is it'll increase breadth, and it's ultimately a bullish signal. But unfortunately, the smaller number, the fewer number of AI names will dominate the overall index returns, even if it's good for breadth in the market.
Mark, the Cosby is clearly tradable. Is it investable?
It's a great question. I would say at this level, it's very hard to buy in as an investment into the Cosby now, unless you have strong belief that the AI capex bubble driven out of the US has a number of months ahead. I think that, again, it's very, very high beta linked to that. So if the AI capex bubble is going to continue, then Korean stocks will continue to do wonderfully despite the volatility. If you're worried that's wobbling, no, you can't invest here because the risk reward's terrible and it's got to just be a trade. So I think that's probably the answer. I think it's more of a trade than an investment right now. I do think that it's important to emphasize that I'm not saying that Cosby is topped. It all depends on the AI capex bubble. And certainly, traders are absolutely loving the opportunities there at the moment.